Here is a number the financial industry does not want you to spend too much time thinking about. 8.71%. It is not a tax rate. It is not a mortgage penalty. It is not some obscure Federal Reserve benchmark that only matters to people with Bloomberg terminals and bad posture. It is the actual average annual return of the S&P 500 over the last 30 years, when you account for the years people tend to forget. The crashes, the lost decades, the quiet erosions. And the moment you understand what that number really means, the entire story that has been sold to you about wealth building in America starts to look very different. So let's talk about it honestly. No cheerleading, no doom, just the math and what it reveals. Start here. The year is 1999. The NASDAQ just hit 5,000 for the first time. CNBC is basically a party channel. Stockbrokers are celebrities. A Beanie Baby investor is telling a reporter on television, without irony, that he expects 40% annual returns. The phrase "new economy" is being printed on everything. And somewhere in the middle of all that noise, a financial advisor is sitting across from a 35-year-old couple. He slides a sheet of paper across the table. On it, in clean bold font, is a single number: 10%. Historically, he says, the stock market returns 10% per year. If you invest consistently, you will retire comfortably. The couple nods. It sounds right. It has always sounded right. And the advisor is not lying, exactly. The 10% figure comes from a real place. It is a real historical average. Morningstar published it. Every financial textbook echoes it. Your uncle brings it up at Thanksgiving. But here is what nobody explains in that meeting. That 10% is a nominal return calculated from a specific starting point, using a specific methodology before the most important numbers are subtracted. And once you subtract those numbers, you get something closer to 8.71%. And once you understand what 8.71% actually does to your money over time, and what it does not do, the comfort starts to quietly drain out of the room. Let us build this from the ground up, because the 10% figure deserves to be examined before it is trusted. The S&P 500 was created in its modern form in 1957. If you measure its average annual return from 1957 to roughly today, you land somewhere between 10.2% and 10.7%, depending on which source you use and whether you include dividends. That is a real number. That is not fabricated. Markets have genuinely produced that kind of growth over the very long run. But here's the first problem. Almost nobody invested in 1957 and left their money completely untouched for 65 years without ever selling, panicking, making a tax event, or paying a single fee. That is not an investor. That is a time capsule. Real people invest at different times. They retire at different times. They need money. Life happens. Markets crash. And when you zoom in on what real investment journeys look like over real 30-year windows, the average is not 10.7%. It is closer to 8.71% before anything else is taken out. That is the first layer. Now let us add the second layer. Fees. If you're investing through a mutual fund, an actively managed account, or even some index funds, you are paying an expense ratio. The industry average for actively managed mutual funds in the United States has historically hovered around 1%. Some are higher, some are lower. A robo-advisor might charge 0.25%. A human advisor might charge 1% of assets under management on top of fund fees. Let's be conservative and call the average fee drag 0.8% per year. You just went from 8.71% to 7.91%. Now add inflation. Inflation is the one variable that every piece of financial marketing quietly leaves out of its projections. The Federal Reserve targets 2% annual inflation. Over the last 30 years, real inflation has averaged closer to 2.5% to 3%, depending on how you measure it. And that is using official CPI numbers, which have their own methodological debates that we will set aside for now. Let us use 2.5%. You're now at 5.41% in real purchasing power terms, meaning that the actual increase in what your money can buy after fees and after inflation is 5.41% per year in a reasonably good scenario. Still sounds okay, right? 5% real growth sounds reasonable. comfortable even, compound interest will still do its thing over 30 years. The math still works. And this is the moment where the script usually pivots to something optimistic, where the narrator tells you that 5% compounded over 30 years still turns $100,000 into $400,000 in real terms. Which is true, which sounds like a win. But we're not done subtracting. Taxes. When your investments grow inside a taxable brokerage account and you sell, you owe capital gains tax. Long-term capital gains for a middle-class American household typically lands around 15%, which means we are now at 3.41%. Let that sit for a second. The industry sells you 10%. The honest long-run average is closer to 8.71%. By the time fees, inflation, taxes, and human nature are done, a real investor operating in the real world often keeps somewhere in the range of 3% to 4% in actual real-world purchasing power per year. That is still positive. That is still better than a savings account. But it is not the story you were told. Not even close. Now here is where it gets structurally interesting, because the 8.71% number is not just about individual investors. It reveals something about the entire architecture of how wealth is supposed to be built in modern America. In 1980, roughly 38% of American workers had a defined benefit pension, a guaranteed monthly income for life after retirement, paid by their employer, fully managed by professionals, with the investment risk sitting on the employer's balance sheet. By 2022, that number had collapsed to around 15%, and most of those are government jobs. The private sector has almost entirely abandoned the pension model. In its place, they gave workers the 401k. The 401k is not a bad product. It has real tax advantages. Employer matching is genuinely valuable. Index fund options have improved dramatically. But what it actually did was transfer the investment risk from corporations to individuals. Overnight, the burden of navigating market cycles, fee structures, asset allocation, tax optimization, and behavioral discipline landed on people who were trained to be teachers, plumbers, nurses, and engineers, not portfolio managers. And then those same people were told with tremendous confidence that the market returns 10% per year and that this would be enough. The 10% figure was not just a statistic. It was load-bearing infrastructure for an entire system. It had to be 10%. Because if it is 10% and you earn a decent salary and you save diligently, the math works out. The retirement is funded. The system is vindicated. But if the real number, after all the silent subtractions, is closer to 3.5%, the math only works for people who started early, earned more than average, never had a financial emergency, stayed perfectly disciplined, and were lucky about their market entry and exit timing. For everyone else, the gap between the promised math and the experienced reality is where retirement insecurity lives. Now, some people watching this are thinking correctly that the solution is simple. Tax-advantaged accounts, low-cost index funds, Roth conversions, dollar cost averaging. Stay the course. These things genuinely help close the gap between 8.71% and what you actually keep. And that is true. If you optimize aggressively, you can recover maybe 1.5 to 2 percentage points of that gap, which gets you to somewhere around 5% to 6% real return for a very disciplined, very well-positioned investor. But the majority of Americans are not in a position to optimize aggressively. The median American household has less than $65,000 in retirement savings. According to the Federal Reserve's Survey of Consumer Finances, more than a quarter of working-age Americans have no retirement savings at all. 46% of Americans would struggle to cover a $400 emergency without borrowing money. You cannot optimize your way out of not having money to invest. The math only compounds beautifully when there is something to compound. Here is the irony that sits at the center of all this. The wealth management industry's entire marketing proposition depends on people believing in the 10% story. The advertisements show people on boats, grandchildren on the beach, a couple hiking in Patagonia at 65. The implication is always the same. Invest with us. The market delivers. You'll be fine. And the industry is enormous because of this belief. Total assets under management in the United States exceed $100 trillion. The financial advisory sector employs over 300,000 people. Fidelity alone manages over $11 trillion in assets. None of that exists without the 10% story. Now here is what makes this structurally strange rather than simply scandalous. The 10% story is not false. It is just incomplete in a way that benefits the people telling it. Fees are disclosed. Inflation is publicly available data. Tax implications are documented. Nobody is technically lying to you. They are just presenting the best possible version of the number and leaving the uncomfortable arithmetic for you to discover later, usually around age 62, when discovering it feels considerably less like education and considerably more like a problem. So what do you do with 8.71%? First, you stop treating it as a guarantee and start treating it as a ceiling. A starting point before life, fees, taxes, and your own psychology take their share. Second, you get ruthless about the variables you can actually control. Fees are negotiable. Tax strategy is learnable. Behavioral discipline is trainable, though it is harder than any robo-advisor wants to admit. Third, and this is the part the industry almost never says out loud, you understand that the investment return is only one component of financial security. The savings rate matters more than the return rate for most working-age people. A 15% savings rate in a low-cost index fund will almost always outperform a 5% savings rate in an aggressively managed account, regardless of what the market does. The contribution is the engine. The return is the fuel. Most people spend enormous amounts of energy arguing about fuel efficiency when the engine is barely running. And here is the question this leaves open. We built a retirement system in America that works beautifully in the brochure and somewhat less beautifully in practice. And the gap between those two versions is not explained by greed or conspiracy. It is explained by something quieter and harder to fix. The system was designed by optimists, modeled on best-case assumptions, and handed to people without the context to interrogate those assumptions. And by the time most people have enough information to understand what they are working with, a significant portion of their compounding runway is already behind them. So the question is not whether 8.71% is a good return. By historical standards, it genuinely is. The question is whether a retirement system that requires ordinary people to navigate fee structures, tax optimization, market timing, behavioral discipline, and longevity risk on their own, with a 10% figure printed on every piece of marketing material like a guarantee, is an honest system. That question does not have a tidy answer, but it does have a number. 8.71%, and now you know what it actually costs to keep it.